Now, I'm constantly buying the SCHD ETF for my long-term dividend growth portfolio, as you see right here on the screen. And this is because I find this ETF to be pretty much as close as possible to the perfect investment vehicle for my specific goals to reach financial freedom in the long term. But what about some of the downsides to the SCHD ETF? Because it's not all good, of course. To be completely fair, in this video, we're going to go through 3 reasons why the SCHD ETF might not be a good investment, and wait until the end of the video because I'm going to share with you a newer ETF that I came across that might have all that SCHD has to offer and even more. So drop a like down below, subscribe, and let's get into the first reason on why the SCHD ETF might not be the best investment vehicle. So for those of you that might not be aware, which I'm sure a lot of you probably are, the SCHD ETF is the Schwab US Dividend Equity ETF, which tracks as closely as possible the Dow Jones US Dividend 100 Index. Now throughout my channel, I have plenty of videos on why I love this ETF, so make sure to go check those out if you haven't already. But once again, we're going to be going over 3 reasons on why this ETF might not be the best investment. Which brings us into reason number 1. This ETF tracks the total return of the Dow Jones US Dividend 100 Index. Which brings us into maybe my least favorite thing about this ETF, and it's the fact that the Dow Jones US Dividend 100 Index has a very specific methodology which allows different stocks to either enter or exit into the index, which is of course how the SCHD ETFs gets all their holdings. Now, if I was to play devil's advocate against SCHD, I would say that I'm not really that big of a fan of some of the top holdings, honestly. Out of the companies Amgen, AbbVie, Chevron, Merck, Broadcom, Pfizer, Cisco, Texas Instruments, PepsiCo, Verizon, UPS, Home Depot, Coca-Cola, and so on and so forth, there's definitely a few names in here which I absolutely adore. Companies like Pepsi. I love the growth potential that Pepsi has to offer, and as of right now, it's offering a pretty good starting dividend yield. Companies like Chevron, I'm also a fan of. But companies like Verizon, I am personally a fan of. I do own a ton of Verizon in my personal portfolio, but honestly, Verizon doesn't have all that much growth potential from here. It does offer a nice sized dividend, but that's pretty much it. So if I was to be completely critical when it comes to the Schwab US Dividend Equity ETF, I would say that the top holdings of this ETF are not necessarily my all-time favorites, although it is hard because with the methodology and the strategy that the SCHD ETF has and the underlying index, for the most part, a lot of these holdings actually do cross off exactly what I'm looking for when it comes to building out a long-term portfolio. But if I was to be honest, there's some holdings in here that I'm not all that big of a fan of. Now, the next thing that I'm not necessarily the biggest fan of when it comes to the SCHD ETF, if I'm going to be completely honest, is going to be the sector breakdown. So now keep in mind, during the reconstitution, a lot of different stocks are going to be turned over and added or exited SCHD's underlying index, so this is going to change on an ongoing basis. But with that being said, as of right now, we have industrials being 18.15% of SCHD. We have healthcare being 16.73% of SCHD. Financials are 15, consumer defensive is around 12, technology is around 11.8%. Now this is the first culprit. I wish the SCHD ETF had a little bit more technology. Now I understand because of the methodology this ETF and index tracks, it's not very likely that there's going to be that many technology stocks that are going to necessarily make the cut. But for my overall long-term portfolio, especially being a relatively younger investor at 31 years old, I want to have a little bit more exposure to technology, which of course I actually get through other ETFs or other stocks I invest into. But the overall makeup of all these different sectors, with industrials, healthcare, and financials being the top 3, it's not necessarily something that I'm super excited about, especially for the reason that over the last year or so, financials have done very, very poorly, as well as industrials and healthcare have been beat up pretty bad. The rest of the ETF is, of course, energy, consumer cyclical, communications, basic material, and utilities. So if I was to be completely honest, I'd probably shift around the overall sectors to be weighted a little bit different if I were to, of course, be able to choose exactly how to build this ETF. But of course, that's not the case. But it is definitely one of the reasons and arguments against the ETF if I were to be real. Now, the final last thing that I would say is a reason to not buy the SCHD ETF, and that feels weird to even say because I'm such a fan of this ETF overall, is because of the future potential lack of dividend growth that we are going to see from here when it comes to this high quality ETF. Now this right here is going to be a little bit hard to read, but basically this is every single ex-dividend date that the SCHD ETF has had and how much it paid out in dividends, and in this column right here, it's going to show the percentage change from the previous dividend payouts. So for example, going down to the bottom, in December 19th of 2011, SCHD paid 12 cents per share per quarter. The next month it paid 13.7 cents, which was a 13.3% increase. Then the next dividend was a 49.5% increase, and so on and so forth. And what's pretty impressive is that since SCHD started, the majority of dividends that have been paid on a quarterly basis have been going up and up and up which is honestly even kind of rare to see. But now if we zoom in till about 2019, 2020 and on, we're seeing that the percentage change from the previous year. For example, the March 2020 dividend was 25% higher than the 2019 March dividend, and so on and so forth. And just as of recently in June, a few dividends ago, we did see a decrease for the first time year over year, which was kind of shocking and definitely got my full attention because I do own a lot of SCHD and I definitely want this ETF to pay me more and more in the future, like it's basically done every single quarter in the past. Now with the minus 5.6% dividend that was paid back in June 2020 paid around 70 cents per share, and then the most recent June paid 66 cents per share. So that definitely got a lot of SCHD investors wondering, is the dividend growth streak year over year finally coming to its match, and is the actual future of SCHD's dividends not going to be necessarily higher from here? And look at every single SCHD dividend that was paid out since the inception of the ETF. It has been pretty impressive on how the dividend growth rate has been so high for so long. And although I do have faith that the dividends are going to continue to be higher and higher, it is something that's concerning a little bit just because there was a recent decrease, and it's something that definitely concerns me when it comes to this ETF. So for those of you that are still watching the video, first of all, thank you. Second off, I promised I was going to show you a new ETF that I came across as of recently, which is DGRW, the Wisdom Tree US Quality Dividend Growth Fund ETF. Now, DGRW is very, very similar to SCHD in multiple different ways. It has grown very significantly, say, over the last 10 or 12 years. Unfortunately, it does have a higher expense ratio of 0.28%, but it does pay a dividend on a monthly basis, which is also helpful for investors that are looking to maybe live off the dividend in the future or just want more cash flow on a consistent basis. Now, the main reason on why I like DGRW quite a bit is because it has a lot of characteristics similar to that of SCHD, but also the holding breakdowns is very different. For example, technology is the #1 sector at 30.47%, which I love once again as a relatively younger investor with a long time frame ahead of me. I want to have more growth potential. But of course, dividends are great also. Then consumer defensive is 15.91, industrials is next, healthcare is next, financials is next, and so on and so forth. But the real star of the show is the top 10 holdings of DGRW. These are some of my favorite companies across the entire stock market. We have a massive weighted position of Microsoft, then Apple, two of my favorite stocks, two of my favorite companies. We then have Broadcom, Johnson & Johnson, Procter & Gamble, the Home Depot, Merck, Cisco, Philip Morris, Coca-Cola, and over 290 different holdings, making it more diversified than SCHD. And the top 10 holdings, in my opinion, absolutely crush SCHD. So with that being said, I think I'll probably start adding some more DGRW to my portfolio, maybe in tandem with SCHD, but because of the sector breakdown and because of the DGRW methodology, I think this ETF could be a good contender for an investor that loves growth, but also loves dividends and loves some of the best companies in the world. So there we have it. There's an ETF to definitely look into if you already own or maybe want to own the SCHD ETF. But on top of that, those are 3 reasons on maybe why it's not a good idea to buy SCHD. Now, I've made so many videos on my channel talking about why it's a great idea to buy SCHD, so don't get me wrong. I just wanted to make this video to be critical and to play the other side and to play devil's advocate for a change. But with all that being said, I want to hear everyone's honest opinion down below. For a long-term dividend growth investor, what is the #1 best dividend growth ETF that you could buy? Put the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.